Good afternoon, ladies and gentlemen. A very warm welcome to our Q3 FY18 earnings call for Banswara Syntex Ltd. And along with me on this call, I have Mr. J.K. Jain, our CFO, and SGA, our Investor Relations Advisors. So let me take you through the performance for the year till date. This has been an exceptionally difficult year, and we continue to fight the challenges that the entire industry is facing. Textile industry players have headwinds and are finding it difficult because of the GST after the demonetization, and many of the supply chain major retailers and the wholesale business in fabric in the textile industry is disturbed due to the GST implementation and the increased working capital requirement post this happening. Currency fluctuation and the increase in the rupee strength, the rising competition from our neighboring countries, and the reduction in duty drawback, which came as a consequence of the GST, impacted our overall growth for exports. So there was subdued demand both in the domestic and export market. And this industry, which was largely driven by many fragmented players, there was liquidity issues across the industry in bringing them into the supply chain with GST, and so there has been tepid demand. Despite the above headwinds, we have seen sequential quarterly growth, and compared to last quarter, our profitability during this quarter is a little bit better. This in spite of the fact that there is an increase in price of polyester by 9% on a quarter-on-quarter basis, which did impact our profitability. And we were also adversely affected by the increase in our power and fuel costs due to the underlying increase in prices of petcoke and imported coal. The price, for example, of U.S. imported coal has increased by 11.5% during this quarter. Currently, the Supreme Court has banned the use of petcoke, and we are then now using the next alternative fuel, which has increased our cost of power generation. As mentioned earlier, we have managed to pass on a 5% increase for most of our products to our customers, of which about 50% have agreed, and we have been trying to get a 10% increase from the rest in many products, which we hope to get agreement by the end of the year. We are focused on creating a better revenue mix. Our garment and fabric business has grown and has contributed almost 66%, in fact, of our 9-month turnover, compared to about 60% in FY2017. So that's a 6% increase almost in the value-added part of our business in fabric and garment as compared to yarn. And we will focus on these two segments going ahead, and we will be using more and more of our yarn capacity for captive purposes or for fancy or value-added yarn, which we hope will help us to increase the margin and elevate us further in our fast fashion business. In the normal scenario, yarn could contribute a 10% plus margin, fabric around 14% plus, and a garment around 15% plus EBITDA margin. And our future strategy is to emphasize more and more on the fast fashion business with customers like Inditex, which is Zara, or H&M's, and also many other customers in the world, in the U.S. market and in all markets, where the trend for reducing lead time and having a better turnaround cycle is a trend which we must support. To support this fast fashion, our product has to be value-added, both in terms of design, quality, and delivered at speed. We have therefore moved into a philosophy of delivering European-styled product made in India and delivered with speed, with prices better than Turkey. And we are emulating the Turkish and European fast fashion reorganization to be able to get speed. We have designers full-time from France and one from the US who design fabric collections based on trends to make our products differentiated and fashionable. We have a partnership arrangement with a Japanese and a European company for marketing. The European company agreement is going to be converted into a joint venture, and we hope that this joint venture will be able to sign by the first week of April in 2018. As far as the Japanese partnership, which is concerned with Takisada, and also extends into Korea and other Far East markets, we did manage in Japan last year to sell about 100,000 meters at an average price of $3.50 in quarter 3, and we have a growth rate from last year in Japan to this year of almost 42% and almost hitting about 25 crores in total sales. And we're growing at a rate of at least 25%. Last year's growth rate has been 42%, so let's see what it will be for the next year in Japan. And our marketing arrangement with Riopel in the global fast fashion business for women's wear, where we plan to make a JV and are in the process of forming that JV, which, as I said, we hope to sign in April, is doing well, and we have made marketing projections there for about 1.5 million meters of sales in the first year, which would be valued at around about $4 per meter, so that would be around let us say $5 million turnover. So $5 million turnover would be about 35 crore turnover in the first year itself of the JV. So, from that perspective, we think that more value-added sales will continue to grow. And as far as we are concerned, the industry has a tough situation ahead. But for us, the situation is looking better. We have improved quarter by quarter. However, we have not yet gotten to the results of last year, and we have a long way to go in improving the EBITDA margin. And I'd like to now hand over the line to Mr. J.K. Jain, who will update you on the financial performance of the company. Thank you very much.
Thanks, Mr. Toshniwal. Good afternoon, everyone. The reviewed results for the quarter and months are already with you. Let me take you through the financial performance quickly. Revenue for the Q3FY18 stood at rupees 342 crores as against rupees 304 crores in Q3FY17. It is up by 12%. Product-wise, yarn contributed 32%, fabric contributed 46%, garment 20%. Thus, the overall contribution of the value-added fabric and garment is 66%. Revenue for the 9 months FY18 at rupees 965 crores against 926 crores in the corresponding period. It is also up by 4%. Product-wise, for the 9 months, yarn contributed 34%, fabric 44%, garment about 20%. The EBITDA margin for the Q3 FY18 at rupees 29 crores against 35 crores in Q3 FY17. The EBITDA margin was 8.4% during this Q3. It was 11.6% in Q3 corresponding period of the last year. EBITDA for 9 months FY18 at rupees 87 crores against rupees 105 crores in 9 months of FY17. In terms of margin percentage, it is 9% in the 9 months of the current financial year. It was 11.3% in the corresponding period. The decline in the margin was attributable to increase in raw material cost, power and fuel cost, and reduction in the export sales. We have reduced our net debt by 44 crores, and the overall reduction during the year would be 61 crores. The company has not planned any major capex in the current financial year and in next few years. The net debt reduction in the following years will also be to the tune of about 60 crores every year, and we are progressing that well. The debt is reducing and the margins are expected to be better. Now we open the call for the questions, please.
Thank you very much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star, then 1. We take the first question from the line of Navneet Bhaiya, an individual investor. Please go ahead.
Okay, my first question is on the normal margins that you just mentioned in your opening comments, Mr. Josniwal, that yarn has 10% EBITDA margins, fabric 14%, and garment 15%.
Under normal situations, yes.
That's right. But there are a few pure play yarn manufacturers that we see. They may be in cotton yarn, which earn up to 15-16% EBITDA margins as well.
That's true, Navneet.
I was just trying to understand the dynamics over there.
So as far as synthetic yarns are concerned, the EBITDA margins are always lower than the cotton yarn manufacturers, primarily for the reason that a lot of the profit of the cotton yarn manufacturers that comes about is due to the buying of cotton. The buying of cotton itself is a trading activity. Whereas when you buy synthetic fiber or filament yarn, it is bought at a price which is controlled by a Reliance or some large company and is based on market price. You can't make any trading profit.
Okay, understand. So, and the same would percolate downwards or upwards to fabric and garment as well?
Yeah, so the main difference is that cotton business has a distributed cotton purchase element to it. And depending on the region you are and how specialized you are in the cotton purchase, you make a margin on the raw material, which makes a big difference to your overall EBITDA. We have no brokerage and no arbitrage possible on the raw material. In fact, in the man-made industry in India, it is more controlled by Reliance and Grasim.
Right.
So, in fact, we are at a disadvantage there as far as the man-mades are concerned. So, really, our margin has to come out of design and product development.
Okay. So the amount spent to build up capacities would also be lower if you compare yourselves to cotton yarn manufacturers?
Not necessarily.
Not necessarily.
No. It could be more. It could be less. But generally, there's slightly less in the synthetics as compared to cotton. That's true. But not too much.
So their return on capital could be higher than those of synthetic.
In general, when you look at the synthetic industry in India, it hasn't done as well as the cotton has.
Okay, understand.
This is true.
Understand. Second, how is your capacity and utilization shaping up right now?
So, as far as capacity and utilization is concerned, we've done well, but there was a little bit of a problem in January because of some industrial unrest with certain absenteeisms that we had. So non-union activity led to a strike for about 3 or 4 days.
That's right, yeah.
So we had that challenge, but we've gotten through it in a very good way because we really had a very firm stand that we will not basically employ anybody who does not spend at least 15 days in a month in attendance.
Okay.
That was the only stand we had taken.
Okay, yeah, that was in Jan, of course. I read that in your announcements as well. But in Q3, you were pretty much at peak utilization?
In Q3, we were fine. Yeah, Q3 utilization was not a problem.
Okay, so in terms of growth, I'm just wondering if your utilization is pretty much up there and if there are no significant...
the problem was that the increase in the cost of the raw materials, the loss in drawback, and the loss in currency rate as far as export is concerned, we were not able to pass it on to the customer.
Okay.
So we have still to pass on about 5% to 7% of our increases in cost to the customer.
Okay, but in terms of volumes, you're pretty much supplying as much as you can, or is there an upside over there as well in terms of volumes?
Yeah, I'll just update you in terms of quantity. If you look at in the last quarter versus the immediate preceding quarter, yarn business quantity has grown up by about 8%, the fabric has gone up by about 11%, and garment has grown by 26%.
Yeah, I mean, so there's very positive growth as far as the garment and the fabric part is concerned. And like we're saying, we are now 66% of our business in fabric and garment and 34% of our business in yarn, which is significantly better than last year in terms of the value addition.
Understand.
Okay, so moving in the right direction except the margin improvement, and that really has been because of the cost escalations that happened post the GST as well as the currency and all the drawback revision part takes some time for the customers to swallow, since we have to quote prices and hold them typically for a year.
Okay. Okay, so do you have capacities to grow your volumes further beyond what it was there in Q3?
Well, another strategy that we have, Navneet, is based on outsourcing. And in fact, what we are doing is we are gradually eliminating those capacities which are more commodity type at our end and increasing the outsourcing of those capacities or converting the capacities at our end to more high-end capacities suitable for better margin products and customers, like our joint venture partner will want from Portugal. You see, we had achieved an EBITDA margin of 17% in 2011.
Yeah, that's right.
And we are convinced that we can get back there, but it is taking much longer than expected. And we have now to restructure ourselves to come back to a situation where more higher margin products are sold, less higher margin products or products where margin is not there are outsourced and sold, and the customer mix and matrix of better value customers is increased. So all of these steps are being taken to try and increase the EBITDA margin in all three parts of the business. And in fact, the yarn part of the business is in shrinking and the other two parts is increasing, which is a good sign.
Okay.
Expect more of that to happen.
Okay, so how do you see everything shaping up in the next time, and what's your comment on the outlook?
Yeah, well, so I was expecting this year to end at least level of last year in spite of all the headwinds.
Okay.
But it looks like it might be a little bit less than last year.
Okay, and FY19?
FY19 should be positive because we will kick in with the joint venture and we will also have a lot of growth coming to us from the US and Japanese market as well as the European market because now the relationships have changed. We are being perceived more as a Turkish company than an Asian company.
Okay.
And we're getting the price increases from many customers when we give them the argument that, you know, you will not be able to counter-source our product from anyone else but Turkey, and the prices will still be higher in spite of our request for a 10% increase or a 12% increase in many cases. And customers just need some time to adjust to that reality. But they're paying.
I understand. Okay, that's it from my side. Thank you so much. All the best.
Thank you.
Thank you. A reminder to the participants, to ask a question, please press star, then 1. We take the next question from the line of Praveen Khandekar from Khandekar Investments. Please go ahead.
Good afternoon, sir.
Good afternoon.
Yes, sir. I have a couple of questions. Can you throw some light on the debt position and what do you think at the end of FY18 it will be and FY19? And can you get us the working capital cycle and way to reduce it?
Okay. I'll let JK answer your questions. Just a second.
Yes. The overall debt for the working capital and term loan both together are about 550 crores. Out of this, about 250 crore is the long-term borrowing for the fixed assets, and about 300 crore is the borrowing for working capital. For the long-term debt, we are almost paying 60 crore plus every year, and in the next 2-3 years also the same repayment period will continue. In every we are just borrowing almost less than 50% of the debt repayment every year. So this way our borrowing is reducing by about 30-35 crores every year.
Okay.
Now, on the working capital side, the overall borrowing of 300 crore is almost all the same, which was even prior to the implementation of GST and all that. Because in the GST also the working capital has been blocked and utilized, and a substantial portion is just not being released by the government. So the overall debt cycle for the working capital is about 3.5 every year, because we have about 1,300 crore turnover and borrowing is about 300 crores plus some bill discounting. So it's roughly around 3 turnover of the working capital borrowings.
Okay, sir. And you said that there will be a 10% price hike you are looking at. Hello?
We requested a 10% price hike from customers. We got 5% from about 50%, and we're still pressing for 10 to 12% with others, and we hope to get that by the end of the year.
So it will cover overall increase the cost of raw material, or?
Yeah, so there will be a 7% increase in our revenue, even without increasing any meters or kilos, and that should help the bottom line, no? That will go to the margin. I mean, the EBITDA margin, if today we only got 9%, let's say, if we got 5 to 7% increase, that would help.
And what are the probability or chances of getting this? And now, what will, if you get, what will be the margin expansion after that?
Yeah, so we expect that the margin expansion after that should get us next year to an EBITDA margin of at least 12 or 13%.
Okay. Okay. And so,
where we expected to go this year, because our objective is to finally come back to 15% EBITDA overall.
Okay. Any timeline for that 15%? Or
well, it depends on how much headwinds we face.
Depends on the market situation.
Just when we thought everything would be perfect in 2-3 years, we had this whole big hit of GST and demon.
Okay. And
if that hadn't happened, we would have been fine.
And besides, one more major hit is because of the increase in the power and fuel cost.
Yeah.
That is the major blow to the company.
Also, that's added to it.
This is an added to.
okay. And so, how long this GST demand effect will be still there?
I think that will last for another 5-6 months, the domestic part of the market. In the export part, it is now foregone conclusion. We lost about 4 to 5% drawback, but that we're getting back from the customers in price. And then there's another increase in another 7-8% in the raw material, etc. So we've asked for another 5 to 7% increases in price. So that's something that's going to adjust. See, when raw materials increase, customers pay for it.
Okay.
But when there is a loss of duties by your government and all other countries in the world do not have that change, then that's much more difficult to get back unless you have a justification for it.
Okay.
So our justification has been that we are giving you European product and it is still cheaper, and our government has taken away our drawback, so we have no choice but to increase the product price. So which customers then say, okay, we'll try and, we can't increase like this, etc. But then they try and counter-source it. When they can't find something, they come back to you and they pay.
But is there any escalation to the thing like that? If there something happens in the tax regime or something like that, we can pass on the prices. There is nothing like that when you take an order from a customer.
No.
Or how the prices are decided on a order basis?
Prices are decided based on a estimation that this would be the raw material price for the next year, and that this would be the drawbacks and situations. Normally the drawbacks and all these haven't changed. They've only gone more favorable in the last 20 years. It's only last year when the GST happened that for the first time the drawbacks fell from a 9.5% to about 4%, to 2% in fact.
Okay.
But we got back something in GST, but the net loss of 5% in all drawbacks across the export of the man-made industry remain. The government is losing export revenue. All of the councils are reporting a loss in exports.
Okay.
This includes the garment industry, this includes the Cotton Textile Export Promotion Council and the Synthetic Export Promotion Council. The government is worried about it, but they don't know what to do because they can't get back away from GST.
Okay. Okay, so the present situation is expected to stay for a couple of months.
So as far as drawback thing is concerned and GST is concerned, we are assuming it is permanent. So all we can do is get back prices from customers and make an offering where you will get prices which are good enough for you to get back to your margin. And the customer will pay that only if he finds that he can't get that elsewhere in the world.
Okay.
So really speaking, the cost advantage that India was beginning to get versus China got diluted.
Okay.
So costs in China are increasing at a faster rate than they were increasing in India. But we lost.
Now, so what's the difference now, or there is nothing?
So, so basically 5% this year we lost, no?
Okay.
In 1 year.
So
that will take us about 1 year, 1.5 years to recover back. Eventually, there is no reason why India should not become stronger in this front. And we have started to recover already.
Okay. The
dollar also, in that sense, the rupee has weakened and become 64.25 from 63. So, all we are looking at is a swing of 5%, no? That swing of 5% has to come about, and it is a repackaging and rebranding of your whole product range that will allow that to happen.
Okay.
Which we are in the process of doing. So, we were saying earlier that in 2-3 years we should start to come back. So we'll still say the same, but we lost a year.
Okay.
It's going to take 1 more year, another 2 or 3 years before we get back to close to that 14-15%.
Okay, sir. Okay, thank you. If anything is there, I will come back in queue.
Sure.
Thank you.
Thank you.
A reminder to the participants, to ask a question, please press star, then 1. We take the next question from the line of VP Rajesh from Banyan Capital Advisors. Please go ahead.
Hi, Mr. Toshniwal. Just thinking about the margin, trajectory that you are talking about.
Right.
Is there an intermediate goal as well, before you get to, let's say, 14-15%? Because, this year seems like we'll be below 10%. And with the structural change that you were just discussing, and the fact that the price hikes will probably take another 12 months to flow in, what would be your sort of...
So my guess for the financial year 18-19 would be about 11.5-12%.
Okay. And on the revenue side, should we assume that it will probably continue to grow in mid-single digits?
We hope to close this year around 1,300 crores. And next year we are projecting about 1,400 to 1,450.
Okay.
But that's all without any capex. We don't need capex for all this.
Right. No, that's helpful because I think it's good that, you are getting out of the low margin products and moving up the chain.
We are moving up the chain. We're getting out. Our strategy has been pretty much this, and I keep reiterating it, and we haven't really changed anything.
Right.
It is about getting more margin products and moving into European-style goods at prices which are a little bit less than Turkey.
Got it. And what is I did not understand the comment you made that people are perceiving you as a Turkish company. Could you?
Yeah, what I mean is that when we go to, say, a Gap, and a Gap says to us that, nobody has increased prices, and how come you guys are asking for increases from India and this and that, none of our customers? So I tell them that, look, the products that you buy from others in India, you don't buy from us. The products you buy from us, you're substituting European products for them. And you're delivering European products in Asia faster than you can deliver from Turkey at better prices than Turkey when you buy my product. So even if I'm asking for this increase, it's still less than what you will pay if you buy it anywhere else.
I see. Okay. Got it. Thanks.
So that is the argument which allows me to get a price hike.
Understood. Thank you so much.
Right. Thank you.
Thank you. Participants would like to ask questions, please press star, then 1. Participants would like to ask questions, please press star, then 1. We take the next question from the line of Shivam Vashi from Alpha Alternatives. Please go ahead.
Yeah, good afternoon, sir.
Good afternoon, Shivam.
Yeah, sir, we can see that there is a significant improvement from the fabric and garment division in terms of revenue contribution. It's about 66% now, right, sir?
Mm-hmm.
But yet we are struggling on the EBITDA margin side. These are the higher margin revenue contributors, right? Fabric and garment.
Yeah.
Yet we,
Yeah, and this has been the challenge across when you look at the results of all the peer group that we have. And the problem has been that raw materials increase in price. We are committed to our retailers to sell at the old price, and the margin gets eroded completely. With the increase in the power, increase in the margin, loss in the drawback, loss in the GST, and the domestic market being really in shambles, it's just not possible to pass on price hikes to the customer.
Okay.
That has been the challenge, and that's why the margin this year is terrible. We never expected it to be like this. We expected that the 10% we asked for would have been absorbed by now.
Okay.
But it didn't.
So you are facing selling on the domestic front more?
Domestic much more than the export part, yes. Our export part is better, and we are able to get the realization faster. And we think that the export front will grow better next year also. The drawback part we had to explain once, and then the customers always have the argument that why is your country being unfavorable to exporters when all other countries in the world are helping exporters? So, I can't say anything except please talk to Mr. Modi.
Right. Also, Q3FY18 call, you said there will be a much more shift towards the integration in your business.
Yes.
So where do we stand now on that, sir?
It continues. We are going to downsize a little bit more of our spinning. We are going to increase the amount of fabric and garment that we do, and that integration will continue. And as we do the joint venture, there will be further more value-added goods that goes to the joint venture. Like, for example, the joint venture is projected to do 35 crores of sales of value-added goods from the same manufacturing capacity we have.
Okay.
Which is why we think we can achieve that 1,400, 1,450 crore turnover easily in FY18-19.
And sir, just want to understand why company is not interested more on yarn revenue. Is it because of the margin?
The margins in yarn are horrible right now in synthetic yarn. Synthetic yarn has got really bad margins right now.
And so where does your debt cost stand in percentage to loans?
Sorry?
Your debt cost, the cost of your interest?
In the spinning part or the overall debt?
Overall interest cost.
Yes, so your JK will tell you.
The overall debt has two parts. One is the principal part,
Excuse me, this is the operator.
Sorry?
Mr. Jain, we can't hear you.
Okay. 1 second. Jake is just going to unmute his phone.
Hello?
Can you hear me now?
Hello? Hear me?
Yes, sir, we can hear you.
Okay. I was telling you that Hello?
Yes, sir. Yes.
The overall working capital cost is about 8% per annum, and the turnover on an average, because these are under TUF schemes, so the average cost for the TUF loans is around 7%. In case of increasing business for fabric and garment, it is expected that the cost of borrowing for working capital will reduce, because for the exports of fabric and garments, we get the interest equalization rebate also at the rate of 3% per annum from the bankers. So effective rate is lower for the fabric and garment business. Yeah, basically the EPC that we borrow is at around 9.5%, and out of that 3% rebate is available. Right. So it's 6.5% for the fabric and garment business. And we are focusing more on that business. So that will bring down the cost of finance in this way also.
Oh, brilliant. That is great, sir. Right. Right. Yeah, that's it from my side. If anything, I'll come back, sir. Thank you so much.
Thank you.
Yeah.
Participants would like to ask questions, please press star, then 1. We take the next question from the line of Manan Patel from Equirius PMS. Please go ahead.
Sir, thank you for the opportunity. Sir, I wanted to understand your domestic business more. So, first of all, is the margin between domestic and export business significantly different?
Yes, at the present moment, we are getting a better margin in the exports than we are in the domestic.
And, sir, what would be that quantum of difference?
Well, I mean, we haven't, this is just more of a broad assessment, but we haven't done the math on that exactly. I would imagine it's about a 1% to 2% difference.
Okay, because I wanted to ask, because still in 9 months, domestic contributes to around 57% of the revenues.
Correct.
So going forward, like in FY19, what would be the mix that you are targeting?
About 50-50.
50-50.
Yeah.
And what time frame do you think before domestic market also kick in?
Yeah, so I would think we've got to give the domestic market another 6 months at least. This was a big shock to the system because a lot of people who were in the supply chain were completely out of the tax net in the fabric business and in the garment business in India. And for them to have to come into the tax net with GST and everything, a lot of them have actually abandoned their businesses altogether. And this whole supply chain has been pretty much disrupted. So it's getting reorganized by the bigger players. Okay. So really it's moving from this unorganized and huge spread of many wholesalers to more consolidation. The retailers is one we are targeting in India are more like Fashion at Big Bazaar or Shopper Stop or Lifestyles. And we're going after the more organized customers.
Right.
And so that part is, good because in fact, a share of the market is increasing. And I think that this is good long-term even for the Indian industry to have this kind of consolidation happen. So, give it 6 months to a year and it should be better.
Right. And so, sir, from what I understand, you said that unorganized sector has significantly gone out of business.
Correct.
So, would that mean that even in next 1-2 years, you could have a significant jump in market share and thus growth?
Yes. Yes, we will have. We do see a lot of players coming into the country from even among the foreign brands. So we used to deal with Marks and Spencer in the UK and they're here in a big presence and we sell to them as well here. Or even Inditex, will begin its sourcing in India itself because the volume is growing significantly. Same thing with an H&M and with others. So we've got to see that growth in India in the garments space and in the retail organized space is increasing. There is a growth in the country.
Okay.
And there's no reason why, therefore, that should not help suppliers like us who are part of that supply chain.
Right. And sir, in domestic, largely our business would be towards garments and fabric rather.
Yarn was the biggest part of our domestic business, and that has been hit the hardest.
Okay.
And that has reduced, and we are reducing that amount of business also now because of the consequence. We just don't understand why we should sell yarn as yarn at those low margins.
Okay, understood. Great. That's it from my side. Thank you, sir.
Thank you.
Thank you. Participants would like to ask questions. Please press star, then 1. We take the next question from the line of Priyanka Singh from Parekh and Parekh Securities. Please go ahead.
Hello. Good afternoon, sir. I had 2 questions. The first one is regarding the exports. So why our exports have reduced during the quarter, and can you give some color on the exports market?
Okay. So, Priyanka, the exports in this quarter, or you're speaking about the 9 months?
No, this quarter. And also the 9 months.
In the 9 months, there is not really a reduction. In 9 months, it's almost the same as last year. There's no real reduction in the exports. But in this last quarter, there was a lot of resistance to the increase in the currency as well as the drawback. And we asked for prices of 10% more from our export customers.
Okay.
And they were not agreeable, so we didn't accept many orders.
Okay.
We were fighting a battle for the price.
Okay, correct. My next question is regarding the labor strike. Like, you have intimated the stock exchange regarding the labor strike, and
yes,
like how much it has affected our day-to-day operations, and can you give some more color into it?
Yeah, so the labor strike that we had was not really in any way big impact on our operations because it affected mainly our yarn operations. And in the yarn operations, anyway, the domestic market was very, very tough. And we were not able to sell the total amount of goods that we were producing. So in a way, instead of stocking the goods, we had a little bit of a less production for a while. But we were able to get a full settlement without giving any concessions of any kind. So in effect, it really helped the discipline, and also the need for attendance among the workers came home very well. So I would say that this has happened after 20 years, and it was sporadic, not supported by the main union. It was one of those fringe elements which are, among the things that can happen randomly.
Okay.
So I don't think that now that it has been dealt with a firm hand, we should be fine for a while.
Okay, that was helpful. Thank you so much.
You're welcome.
Thank you. Ladies and gentlemen, as there are no further questions from the participants, I would now like to hand the conference over to Mr. Toshniwal for closing comments.
Well, thank you everyone for attending this conference call and being patient with us. We continue to work on the same strategies that we have been saying we will do, which is to increase value-added production and to find ways to escalate our margin with customers while at the same time reducing our costs and getting out of the areas where we find ourselves in a commodity space. So we continue to work towards those directions and hope to be able to get better earnings going forward. We thank you everyone for your support and patience.
Thank you very much, sir.
Yeah.
Ladies